Ladies and gentlemen, welcome to Entrepreneurial Finance. Entrepreneurial Finance in theory, the general approach. What is a theory of entrepreneurial finance? Is there a theory to entrepreneurial finance? Let's start with an example. This is the share of Facebook. Facebook went public in May 2012. Actually, there was big speculation on Facebook whether this is going to be a good investment or not. And actually, they started with the share price here, and then the share price dropped, and it is close to 50% of the share price after just a very short amount of time. So people say, yeah, this is never going to work. They never convert users into money. Well, obviously, they had some good ideas to do that. At least broker or shareholders believe that, because the share price is back, and not back, is more than what it was before. What is the underlying issue there? Actually, when Facebook started to go online, people were very insecure whether this is a good investment or not. And why? Because there was no good reports on that. There was no history they could track. There was just speculation on the business model and so on. So nobody really knew what's going on. And this is very typical also for entrepreneurial finance. But now we are in the phase of this is more corporate finance. People are investing in Facebook as a corporate. What are the underlying principles theoretically for investments? Actually, the underlying principles are four. The first one is there's a two-sided interaction. One is buying shares, one is selling shares. This is Facebook example. When they went public, they sold the shares to the public was buying the shares. That was two parties interacting in a process. Secondly, there is some divergence of interest. Is there really a divergence of interest? Well, there is a utility function. However, in corporate finance, that shouldn't be important, because you invest in a company, you don't invest into people. Facebook, questionable, but if you invest into Daimler, for example, some people don't even know who is the CEO there. Some people don't even care who is the CEO, because the interest of the CEO shouldn't play a role. And actually, if you look at board decisions, the CEO shouldn't have too much influence just being the CEO. The third point is time dimension. You always invest over time. So if you invest into equity, you invest because you think you can get some dividends on the one hand, and you can make capital gains on the other hand. So you buy lows, you sell high. There's a time dimension. There's a long-term temporary interaction. Maybe short-term, but a temporary interaction. And the fourth point is there is still an information asymmetry. In capital markets like the stock exchange, we think that there is no information asymmetry or close to no information asymmetry anymore, because there's so many broker reports, so many analysts covering the companies, that information is divided equally. You might question that, but in corporate finance, these are the theoretical principles which are the basis for corporate finance decisions. What it is in entrepreneurial finance. Let's look at that a little closer. Well, in entrepreneurial finance, we do have owner-managers. And in the Facebook example, we always look at what Mark Zuckerberg is doing. In the Apple example, we looked at Steve Jobs. Now we're looking at Tim Cook, and we think, is he innovative like Steve Jobs? Is he not? Can the company perform the same way? This is typical for entrepreneurial finance. Actually, this is typical, first of all, who are companies who are dominated by owner-managers. Managers that also own a significant share of the company. That's the Facebook example. And this is in Facebook case that made Facebook very successful, because it was much better than MySpace. I mean, the Facebook idea, social communities, started in 1998, basically. Facebook in 2004. Why did this company get so successful? Actually, parts of it is a clever owner-manager. Same with WhatsApp probably, same with Amazon. I mean, Barnes and Nobles had all the books, they had the bookstores, they had the books in the bookstores, they could have done a website and sell the books. Same thing as Amazon did. Amazon had nothing. Amazon is the successful book dealer today. Barnes and Noble, not that way. So there has to be some kind of influence in these companies of these people, these so-called owner-managers, that make these companies successful. The exploratory spirit, the discipline, the business sense, whatever. This is entrepreneurship, to look at owner-managers and the way to make companies successful. So the first thing is, if a company is dominated by owner-managers that are able to make the company successful and also unsuccessful, it's a different situation. The other kind of part of different situation is what you can also see here. We have Facebook as an example. We can also take Segways as an example. When Segway started, beginning of the 2000s, I think 2001, about that, there were people saying, and actually Steve Jobs said that Segways is going to revolutionize the market for private transportation as the computers revolutionized the world of working. Did this come true? Actually, not yet. Or is it never going to be true? So people failed in predicting what could happen with Segways. Even Steve Jobs, a very, very visionary personality, probably one of the most visionary personalities we had in entrepreneurship. I mean, people are using Segways, but they didn't revolutionize the way people were doing their transportation. And this is very typical for startups. This is very typical for new technologies, new ideas coming into market. Even if the technology might work, and this is also not always clear, but even if the technology might work, the market might not adopt that. The market might not want that technology. Having said that, this is the uncertainty which plays a big role with new companies. Same with Facebook. I mean, what do you have invested into Facebook in May 2012? What do you have invested into Facebook before, when they started? 2004, a Harvard dropout with no track record in entrepreneurship, just having the idea, being in dorm room in Harvard? Well, maybe, but most people wouldn't have done that. Because of the uncertainty, and because they didn't know the person. But the person was dominant in making that company successful, and he was able to reduce the uncertainty, at least to some extent, that people think nowadays it's an interesting investment. But that's very typical for entrepreneurial finance. And if you look at that, you will see that there's no perfect market. Because what happens is that information is not distributed equally. So first of all, no perfect market. Secondly, to find these companies in Harvard on the campus, a guy who's starting a company is going to be a multi-billion company, it's not too easy. There's positive transaction costs. If you want to buy shares, you go to the stock market, it's easy going. If you want to invest in small startups, you have transaction costs because you have to find them. You have to find the interesting ones. And it always depends on the individuals. If you have an individual like Mark Zuckerberg, he might make your investment very successful. But do you know before? There's many entrepreneurs, many founders who never want to sell their companies, who even don't want to bring the company public. Is this a good equity investment? Probably not, because equity investment is buying shares, selling shares. If you do not have the chance to sell shares, it's not a good investment. And last but not least, maybe founders do business class flights, and you don't want that because they take it from your investment, and this you don't consider this investment, you consider this just spending. So what you need is, you need a theory that is covering these basic assumptions, and this is the new institutional economic theory. Because the new institutional economic theory is two-sided interaction and time dimension, the same as we had before, but it can also cover the divergence of interest between the entrepreneur and the capitalist and the information asymmetry which is there. And this is basically being done in, for example, principal-agent models. Principal-agent theory as part of the new institutional theory is probably one of the best theories that can cover that relationship between entrepreneur and capitalist in that situation with high uncertainty and an owner-manager dominance, an owner-manager who can make a company successful but has own interest which you have to take into account when investing into this company.